Okay, for this video, I want to go over the IRS Form 8283 for non-cash charitable contributions. So this form is completed and filed with your 1040 if you donate something other than cash to an organization. So if it's a car, household items, clothing, publicly traded securities, real estate, other types of non-cash property, you might need to complete the 8283 and attach it to your return. So I've got the 8283 in front of us, which we'll go over. And then I also have two slides which cover some background information on property contributions and then the fact pattern that we're going to be looking at. So first, I want to go through just some general background on what the 8283 is designed to accomplish and who needs to complete it. So again, this is a form that's used to report non-cash contributions of property, right? So that can include securities, real estate, vehicles, clothing, furniture, art, other types of collectibles. If you donate something of that nature, you might have to do the 8283, and then in some cases you may need to attach an appraisal. So you'd have to have the property appraised before you go ahead and donate it to the charity, and you'll have to include that appraisal with your return. Now, the number one question is always, well, how much can I deduct, right? And that's a fair point. So the amount you can deduct when it comes to charitable donations depends on really two big items, right? So the first one is, what are you donating? So what kind of property are you donating? Is it cash? Is it ordinary income property, capital gain property, so on? And then the second question is, who is the recipient organization? So there's different rules when you donate money or property to public charities or private operating foundations, non-operating foundations. Different rules apply to each. Now, cash is always kind of an easy one. So if you donate cash to a public charity, the donor can deduct the cash up to 60% of their AGI. And again, this 60% limit is in effect now, but it's set to expire January 1, 2026, unless it's extended. So the old rule was 50% AGI limitation. The Tax Cuts and Jobs Act changed that to 60, but again, it's just temporary unless it's extended. So what about property donations? So the donations of property to public charity, that still gets the 50% of AGI limit. So if your AGI is 100,000, your 50% of AGI limit would be 50, right? So you can donate to charities, and the property value can be up to 50 and still get a full donation without having to worry about any carryover. Now, this is where most people stand when it comes to how to calculate the amount that's deducted, right? So when the property value decreases, and so when we think about this practically, when you buy property that you're using and then you wait a couple of years and donate it, the value always goes down. Very few things actually appreciate in value. So for example, if we had a used couch that you purchased 4 years ago for $1,500 and the fair market value is now $600, the value of the deduction is going to be $600, right? So you'll get a $600 non-cash charitable donation. Now, what happens in those rare occurrences where the value increases? This is when you have to determine whether it's ordinary income property, so short-term property, or it's long-term capital assets. So in this example, and this often happens with private foundation contributions, but let's say you own stock in a publicly traded company for 8 months. The value is $5,000, but you purchased it for $3,500. So you have a $1,500 unrealized short-term capital gain. If you were to donate this property, you can't deduct the $5,000. You would deduct your $5,000 minus the unrealized appreciation. So $3,500 would be your charitable donation, right? And again, this last note here, different rules for capital gain property that's held on a long-term basis, right? So again, be very careful with what are you donating and to what organization, because it's going to impact the amount of the deduction and then the AGI limitations. All right, so let's look at some rules for clothing and household items. So the rules are pretty straightforward, honestly, from a tax perspective, right? So one big item to remember always is you can only claim deductions if the property is in good condition. So when we think about the hierarchy, we're looking at good or excellent condition, you can get a tax deduction for those items if you contribute them. If the condition is in fair or poor condition, so these are the terms used by the IRS, you can't claim a charitable deduction. So you can't donate your trash to a charity and try to claim a charitable deduction. That's not going to work. The one exception is if you do donate fair or poor quality items, but the value is still high and you have a qualified appraisal, then you could deduct them. All right. But in most cases, again, we're trying to be, when we're trying to be charitable, we're trying to donate used items that are still in good or very good condition, right? We're not giving away trash to charities. So remember, first thing is always clothing and household items got to be in good or excellent condition. And then when we talk about how do we determine the FMV, you're always asking yourself, well, what would a person actually pay for these items? So if I donate something to Goodwill and I go into the Goodwill, what are they going to be listing it on the shelves, right? If I go to a thrift store or other kind of consignment shop or try to sell it online, all of that stuff is relevant. Now, clothing, come up with fair estimates, right? Reasonably fair estimates. What the IRS does recommend is if you are donating larger, more expensive items, so furniture, other household items, do a little more due diligence on figuring out what the fair value is. So if you donate a piece of furniture, conduct an internet search, right, to try to find comparable property online, so eBay or Craigslist, see what other people are selling similar items for, and then that's how you can kind of set the rate that you're going to claim as the charitable donation. Now let's look at the fact pattern here for John. So John is moving house, right? So he wants to donate some of the used household items before he moves into his new apartment. And so John is looking through and he finds, well, I got some used clothing that I no longer wear, and I have a kitchen table and chairs that I want to replace when I move, so I'm going to donate them before I move. Right, so he looks at the used clothing, and it's got some suits in there, dress shirts, shoes, t-shirts, and he estimates that the total fair market value of all these items that he's going to donate in just one go is $300. And then he also kind of estimates, well, I think I originally paid about $1,000 for all these, right? Think about the big items first. So what did I spend on this suit? And then maybe my t-shirts are $25 a piece when I originally paid for them. So I got $1,000 somewhere in there. Now with the table and chairs, he does an internet search, right, to try to find some comparable sales. And he finds that, okay, that my table and chair set that I bought years ago for $2,500, now it's worth about $850. That's what I can see a sale for online. All right, so he has that information at his disposal, goes ahead and donates them. So now he completes the 8283. So 8283 is 2 pages, Section A, Section B on the first page, and then there's a second page that has appraisal signatures or donee signatures, but those aren't required in all circumstances. So when you donate property to charity and the property is $5,000 or less, you can complete just Section A, and then that's sufficient. And you also don't need to have a qualified appraisal attached to these items. So if we look at Section A in these circumstances, so the men's clothing, good, used clothing in good condition. He donated this to this charity here, so Not Real Charity Inc. in Bradenton, Florida. And then on line item A, he's indicated, okay, made the contribution on October 1st. Various dates which I acquired the clothing, right? He didn't buy it all on one day. The acquisition was by purchase, right? So this clothing wasn't originally gifted to him, right? So he purchased it. His original cost basis, he estimates, was $1,000. And then again, he estimates the fair market value is $300. Now, method used to determine the FMV. For used clothing and other items like this, the thrift store kind of comparable sale valuation is what's appropriate. So you can put thrift store for these items. Obviously, if you had an actual appraisal done, then you could put a qualified appraisal. But in this case, the thrift store valuation that he's come up with is sufficient. So he does the same thing for the kitchen table and chairs, right? $850 is the FMV. His original cost basis was $2,500. He purchased it. And then we have the month of acquisition and the date of contribution. Now, once all of that's done, he can skip Section B, right, because he hasn't donated any property exceeding $5,000. And so he's got his fair market value of the non-cash contribution, so that's $300 plus the $850. And so that total amount is reported on Schedule A as an itemized deduction. So we can see there the 800 and the 350, so the 1150 total report on line 12, gifts to charities. And so that's included with his overall itemized deduction. So we also donated some cash to some other charities, and he's got his other mortgage interest, taxes. So John's total itemized deductions there are $14,369. That includes the non-cash charitable component. All right. So that covers it for this video. I hope that was helpful. If you have any questions, feel free to leave me a comment below. And I look forward to seeing you again on the next video. Thank you.